Morning, everyone. Is anybody at the game this weekend? So, sorry. Yeah, well, you were ill, so it makes sense. Yeah. So I was at the game. I was helping out with the DSP concessions, and by helping out, it means I was pestering Carson with a whole bunch of questions. So yeah, I did something that I'm not proud of. I did something I'm not proud of. So it was 90 degrees, and even in the shade, it was pretty rough. So Truman State, the middle of third quarter was down 21-7, and I'm like, you know what? I've lived through this many times before. So I left because I was dressed in jeans, which was a bad idea, and I had some other stuff I had to do, so I left. And then Truman State came back and won the game. Okay, so kudos for them. And it really depends on one thing. So you get to criticize me in one of two ways. You can either be Dr. Barnes, you fool, you should have had faith, okay? Which, if that's the case. On the other hand, if you think that I was the reason that Truman State was losing the game and my departure actually freed them up to actually win the game, then you can thank me. Say, thank you for showing up for leaving the game so that we didn't have your bad mojo there, Dr. Barnes. Don't come to any future games, okay? Whichever your perspective you have, you can criticize me, but yeah, I definitely had my share of the blame there. But yeah, it was encouraging because I heard a lot of student names that I work with called on the football field, and they were doing well, so it was kind of nice to hear that. Yeah, so that's the highlight for today, guys. It's downhill from here. So but we're going to talk about the revenue process today. So a little bit of background. You hear me refer to this as the revenue process. Much like everything else in the book, I have a different title for this section than the chapter of the book. You know, on the slides, I actually call it the name of the title of the book, the sales and collection process. But everywhere else I've ever read it, it's ever called the revenue process, which makes sense because that's how you learn it early on when you're learning about the process systems in your other classes. And so that's the vernacular I'm going to use. So keep in mind, whenever I refer to the revenue process, this is the chapter I'm referring to. And this is basically using the idiom that in the United States, this is where the rubber hits the road. This is basically where the car starts moving. This is where we're going to take all the things that we've learned in the previous chapters, and we're going to apply them to a specific reference. We're going to do that for the next 3 chapters as well. We're going to do that for 7, 8, and 9. Chapter 8 is going to be the purchasing process, which is going to be very familiar because it's basically the flip side of this process. And then we're going to talk about inventory in chapter 9. And then beginning of week 8, I got an exciting time for you all. We got an exam, so that's not too far off. How do you feel about exams right before a break? Does everybody like that? Is like, okay, or does it just like it's like I'd rather just, I'm already stressed out enough. I'd rather just go into the break, not being stressed. I kind of view that as one of those things that it's got of those alternate quirks. On one hand, everybody's going to be really, really stressed out. Plus, I've heard that a lot of instructors plan their courses to be right to do exams right along breaks. I don't do that intentionally. I put the exams where they fall just based on what the schedule looks like. But if I cause you stress around a break, I'm sorry, that's not my intention. I will tell you that one of the interesting stress points is going to be my auditing class. They're actually taking an exam right before Thanksgiving break, and they don't get the results of that exam until after Thanksgiving break. So that's got to be like the most brutal torture you can ever have. Yeah, that's for those of you who are accountants, that's the CPA exam right there. Taking an exam and then not getting the results for like months afterwards. Yeah, it's a rough time. Anyway, before we start this, I want to clarify something because I think it's important to make sure that we understand where we're at with respect to our business processes. So basically, a business environment can be in one of 2 areas, and these are not exclusive. They can actually be both, but I do want to make a distinction. So is everybody familiar with the environment of business to business versus business to customer? Have you heard those terms before? If you're not familiar with those terms, let's clarify because they have very important implications for what we're going to be doing here. Now let's start with the simple one, business to customer. I'm assuming everybody in this room has done some sort of business to customer transaction. How many people in the room think that they've done a business customer transaction before? All right, well, that's a lot fewer hands. It should be 100% because I'm assuming that most of you have to go buy your own groceries. If you're like, well, I have my butler do that, then come talk to me. I've got some things that I need from you. All right, if you're like, I got my serving staff take care of that for me. So business to customer transaction is just where we have one business that's selling directly to the end user, okay, to the customer. So anytime you go and you buy your cheeseburgers over at a restaurant or let's use one that's more relevant. I had a cheeseburger last night. That's why I've got cheeseburgers on the brain. So let's go to Taco Bell. How many people in here like Taco Bell? There were a lot more hands for that question than were for my previous question. Wow, misery. I actually used to like Taco Bell before, but then I turned 30 and then my body said, yeah, you don't like Taco Bell anymore. It's not that the flavor is not good. It's just I understand what the consequence of eating Taco Bell will be at my age. So, yeah. So you order your taco from Taco Bell. We'll just go with the basic taco from Taco Bell, and you think about the transaction series is that you place your order, they give you they tell you how much you owe, you pay that, and they deliver your taco. Business consumer environment is generally characterized by one cash disbursement or one cash receipt to one transaction. Pretty straightforward. Now, this is going to be different from what we're going to be talking about in this chapter as our primary mechanism. It's going to be our business to business environment. Now, I want to say that we can still use the template that we're talking about here as a business to customer template. But for a business to business environment, it's a little bit different. So think back to 220. Think back to when you're taking 220. Remember 220 in this class? I'm actually at the point now, it's like half the people in the class have been raising their hands and everybody else has just been kind of tuning me out. So I'm going to continue having you all raise your hands and see how many people are paying attention when I have those. All right. So how many people remember 220? A lot more people raise their hands on that one. So they don't remember business to customer environment, but remember 220. Yeah, okay. Now, so 220, you learned about accounting. And what was the characteristic of accounting? Was it that you recognize transactions when you receive the cash, or is it some other recognition? It's that weird thing called accrual-based accounting. Remember that? It probably should have been really unfamiliar with you back then. Back then, you were just kind of like, accrual-based accounting. What's that? That's so weird. Now you're just kind of like, okay, I've taken 2 courses of this, Dr. Barnes. Move it along, move it along. So accrual-based accounting says that we can recognize revenue and recognize expenses when they occur, as opposed to when the cash transaction for associated with those occur. So why is that important? Well, think about a business-to-business environment. This is one business selling to another business. A lot of times that's characterized by numerous transactions over a short period of time. Is it efficient for one business if they conduct, say, like 10 transactions within a week window to make disbursements every single time they conduct a transaction? Prevailing logic would say no. I mean, it may actually be more relevant today since we have got more electronic transactions than before, but there is a transaction cost for every single one of those. So it may just make more sense to combine all those transactions into one payment or to one future payment. So we consolidate those payments and then we assume the customer is going to make a payment on those at some point in the future. That's the business to business environment. It's usually characterized by numerous transactions. And the reason this is important is if they're going to make payment on those transactions in the future, there's going to be a time period between when the transactions occur and when payment is made. All right. Is everybody familiar with the idea of granting credit? The accrual-based environment that we dealt with in accounting, this idea necessitates this idea of credit. It also creates a whole bunch of other issues. It creates some recognition issues, which, if done inappropriately, can lead to fraud and can lead to all types of collusion and it'll lead to all types of nasty things, which is one reason why I kind of say accrual-based accounting is overrated. But you're not here to paying me for my opinion on accrual-based accounting. You're paying me to learn about the revenue process. I'm going to teach you about that. But I do think it's important to understand that all transaction systems are not equal. How we characterize a business to business transaction is going to be different from how we characterize a business to customer transaction because of the nature of the environment. All right. So to start off with, nature of revenue transactions will vary depending on the types of organizations. This should be somewhat already familiar to you because when you started out in 220, when you started out in your first accounting class, you were learning about merchandising firms. And it's like, well, this is pretty straightforward. I understand. I get the inventory. I sell the inventory. Not too much deal. Then they expanded upon that in 221. And in accounting 221, you had to learn about manufacturing and you had to learn about that work in process stuff and all that nonsense. And you had to say, all right, this is a little bit more complex, but still very, very relevant. And you had to learn a little bit about service firms. There's also other types of accounting out there. There's accounting for governmental entities and not-for-profit organizations. So the way that we recognize revenue transactions are going to be different, not dramatically different, but different depending on the nature of the organization. Our focus in this course, we're going to try to stick with manufacturing and merchandising firms. We are going to have some service elements because I think that's important to incorporate. But keep in mind that this is not going to be substantially different from what you learned in your other classes. And we're going to actually look at some transactions and we're going to talk a little bit about how those apply. These transactions should not be difficult. They should be transactions that you're already familiar with based on your other accounting experience. So what are the fundamental functions of a revenue process? Well, there are going to be 4 that we're going to talk about in this course, and these are going to be kind of guide how we're going to set up our activity models. activity and structure models, I should specify. So we have receipt of the sales order. All right. Now this includes, I should probably add here in addition to the bullet point here that says the sales or credit authorization, this includes a request by the customer. This is going to be a quote where the customer says, I'd like to know how much it's going to cost, and we can give them a quote for that. The quotes are not always relevant simply because some transaction models do not require quotes. So for example, whenever you go in, you're going to buy your burrito at Taco Bell. I'm going to change foods all throughout the day today. Okay. We started out with tacos. Now we're evolving to burritos. You buy your burrito at Taco Bell. You don't say, can you quote me on how much this burrito will cost? You just look at the menu and say, oh, okay, burrito's $2.50. I can afford that, pay $2.50 for the burrito. But in many situations, you may want to quote, especially if it's larger projects. Like when a company buys a aircraft from Boeing, they're going to have a very detailed quote on the prices of that. So really, the complexity is going to necessitate the need for the quote there. But when we did agree to engage in a transaction, the customer is going to send in a sales order, and we will receive that. Again, for the revenue process, we're assuming that we're the one generating the revenues. So this is kind of our being the perspective. We're the vendor in this scenario. All right. This is also going to include credit authorization. Why do we have credit authorization? Because we want to make sure that if we extend credit to a customer, that the customer will pay us back. That's a really important one. We can have all the income in the world, but if we never receive the cash for that income, it doesn't matter how profitable we are. We have to have cash to operate. So income is by necessity has to be tied to a eventual cash receipt of those income amounts. Then we're going to have shipment of goods. That's going to be very, very obvious because we have to send the goods to the customer if we promise that we're going to send those. Same thing for service, delivery of service. This is going to include inventory management processes, not detailed inventory management process. We'll get into that in a couple of weeks, but at least some remedial ones. Also, something that I want to allude to a point, because this is going to be fairly relevant, especially with our activity diagrams, our BPMN models. There are going to be something we call freight on board. Has anybody heard the term freight on board in their classes before? It's usually characterized by FOB. There's two possibilities for freight on board. There's freight on board shipping point and freight on board destination. Does everybody understand the difference between those? So they're spelled differently, Dr. Barnes. Okay, the spelling, you're right. Okay, but what is the difference that I'm concerned about? Shipping point basically means that once we send the goods to the customer, once they have left our warehouse, it is now the customer's responsibility. We have recognized the sales transaction and we can move on. Whereas the shipment of goods recognized by freight on board destination means that they're our responsibility up until they reach the customer's warehouse. So that's a really important characteristic, and that's going to dictate revenue recognition points. Okay, so we need to know, is it freight on board shipping point, freight on board destination? Now, this is a really important point. Absent any other information in this course, I want you to always assume freight on board shipping point. So once they leave our warehouse, we recognize revenue. Will there be scenarios where we change those situations? The answer is maybe. Okay, that may come up. But if you don't have any other information, let's just default to freight on board shipping point. All right, issuance of invoices to bill customers. Okay, we're going to actually send the bills to the customer saying, all right, we've done our part. You're going to have to do your part too. These are going to include adjustments for sales returns and allowances. So sales returns, everybody should know that. Sales returns should know that sometimes customers are like, we don't like this. This is low quality. It's not what we wanted. Sometimes they're going to say, this is not what we ordered, and return it, and they're going to get credit back for that. What about a sales allowance? Are sales returns and sales allowances different? Obviously, I wouldn't include the word allowance on here if they're the same thing. I'm not in redundancy, at least not intentionally. I am pretty redundant at times, but I don't intentionally get redundant, especially on slides. So sales allowance is basically a sales return, but there's no corresponding return of merchandise. For example, let's say that you're a service company and you do like a cleaning of a location, and they say, we're not happy with the cleaning of location. They say, okay, we're going to issue a refund, but we're going to put all the dirt that we clean back in your location. Okay, we're going to empty our vacuum cleaners, put the trash back. That's not practical. It's not pragmatic to do that. Generally speaking, allowance is when there's a return of a refund, but there's no corresponding return of merchandise. This can actually happen in case of imperishable goods too. So if you order from a restaurant, so you order for pepperoni pizza from Domino's, and they send you a Hawaiian pizza, and you're just kind of like, this is the worst day of my life. All right. I don't know how you feel about Hawaiian pizza. Anybody a big fan of Hawaiian pizzas here? Okay. I actually don't mind the pineapple. It's the ham. The ham is just what gets me. Okay. That's why I go with pepperoni. But you know, to each his or her own. There's going to be food out there that I like. I'm sure there's some vegetarian out there in the class right now that every time he says the word cheeseburger, I cringe a little bit inside. Okay, and I apologize for that. That's not intentional. But if they send the speeds out to you, it doesn't make sense to return it because they can't break it down into component ingredients. Plus, that would be gross if they did that. Also, a quick note here: has anybody ever ordered perishable goods off of Amazon? You notice I'm still doing the raising of hands here. Okay. So yeah. So occasionally perishable goods can be ordered on Amazon, and sometimes they will ship you the wrong goods. Here's a note. If they ship you the wrong goods, they will say, hey, we'll give you a discount on those goods if you want to buy them. You should say, no, I don't want to buy them. Why? Because you're not contractually allowed to return perishable goods via Amazon. That's actually written for anybody who sells perishable goods on Amazon. They can't return perishable goods for obvious reasons, okay? Because contamination could occur. And so if you are shipped the wrong goods for perishable goods, you get to keep them. All right. Isn't that great? I'm teaching you guys bad behaviors. Isn't that great? Yeah. Yeah. So yeah, make this so people are going to be like, oh, I'm going to order $1,000 worth of perishable goods on Amazon and then say I got the wrong ordering. Thanks, Dr. Barnes, helping me commit fraud. Yeah, good job. Do what I can. Do what I can to make your lives better. All right. Receipt or recording of customer payments. This includes receipts. So obviously, our customers are going to send us their payments. We wouldn't do business with them otherwise. Usually, if a customer fails to send a payment, that's where they no longer become a customer. We say no more business done with you. This is also going to include adjustments for cash discounts. So we talked about returns and allowances and how those can actually be deducted from invoices. But we also have this other deduction for cash discounts. You may have heard this term 2/10 N/30. Is that hieroglyphics that I just put on the slide? Yes, it's hieroglyphics. Okay, I'm teaching you all how to talk in hieroglyphics. No, 2/10 N/30. 2% 10 and net 30. That's trying to encourage people to pay early. One of those things is like if we take a small discount now, we can get cash much earlier on and guarantee that we'll receive cash receipts from our customers. So that's one of the motivations behind that. But that will reduce the amount that we receive. So here's a review of revenue transactions. This is going to be similar to how we would recognize revenue transactions in environment. Again, there's nothing too mind-shattering here, but we will come back and talk about the transactions on this slide because some of these transactions are extremely relevant, okay? Like when do we recognize the accounts receivable versus the sales? I'm not going to talk too much about the tax items here. This was included as native to the slides. If I were ever to ask you to include or to record a transaction, which is very, very unlikely that I will do that on the exam and very rare that I will actually ask you to do that in homework. But if I do, it's going to be without taxes. I apologize to Dr. Caden, but I'm trying to keep things simple here since everything else is already complex. So the inclusion of taxes, not necessary. But we recognize the receivable and the sales, and we recognize the eventual payment for sales. We're actually going to also recognize cost of goods sold and then cash for the accounts receivable. Now, there's a couple of things going on here that are interesting to note. That we've got accounts receivable that could be received, and then there's actually eventual payment for sales here that occurs on the same day. All right. So this is where we're saying we're selling products for cash. There's no actual generation of accounts receivable. Like if you go to Taco Bell and you buy the Mexican pizza, I told you guys I was going to change products on you. Okay. If you go buy the Mexican pizza, they don't generate a receivable, then immediately clear that receivable by the cash payment. It's just a transaction for cash right then and there. All right. Obviously, recognize the reduction of cost of goods sold and recognize the creation of an expense for cost of goods sold and the reduction of inventory. And then we need to record the eventual cash receipt for this transaction right up here. Again, all of this stuff that's just repetition, what you learned in 220 and 221. This is not important unless, of course, you don't remember this. If you don't remember this, you may want to spend some time on the slide. But I'm assuming everybody does remember this, can actually do basic transaction analysis, so we can move on to how we apply this into real world. So our example for the next few chapters is going to be a company called Sunset Graphics, and this is the book example. They are a manufacturing company. They create and design graphics, and they sell designs and banners, letter and vinyl graphics for vehicles and boats, corporate promotional items, and silkscreen T-shirts and embroidered gear. Now, there's an interesting reason why we're choosing this particular company. They are indeed a manufacturing company. They create all the items that are listed here. But it's also important to note that they can actually do application of these items. So say, for example, you have graphics that are supposed to be applied to a particular item. That would consider to be a service item because you're taking a good and you're applying it to another good. It's not actual generation of merchandise. It's taking two pieces of merchandise and kind of doing a service with them. So we can actually have service elements included here that are native to the organization. That's going to throw a little bit of a wrinkle, but an interesting wrinkle because we'll see how we actually apply those particular scenarios in the same environment. All right. So the breakdown of the revenue process description, this is a summary of what's going on page 285. And this is a really important slide because this is going to dictate how we actually recognize these transactions from our activity models and our structure models. Better yet, better suited to knowing the BPMN diagrams and the UML diagrams. How are we going to recognize that? Now, I want you to make a note of this because this is going to be very, very important for the exam. What we're going to learn here as a framework will be basically the same framework that I will expect you to know in the exam. There will be a few wrinkles in here that are going to be unique to this particular company that you do not need to include in your diagrams on the exam. But basically, if you learn the diagrams that we're going to learn in this chapter and the subsequent chapters, you should be good for the exam. And I'm going to point out a few diagrams and say, learn this, know this, love this. All right. If you do those things, then you should be fine for what you need to know. So preparing a quote for products and services to be provided to the customers. This is one of those business models that we assume a quote is necessary because they're providing large enough products and services that people want to know how much is this eventually going to cost me. Okay, so the quote's going to be important to note. Customer placed the order for all the parts or quoted products and services, so they're going to place a sales order. It's important to note that the quote is not necessarily applicable to everything. If they ask, I want to actually possibly do this, customer may say, all right, this is too much, but I will do part of this order. They can actually do partial orders as well. Orders any products not in their inventory from suppliers. So this is part of the purchasing process that we're going to discuss next week, but also an integrated part of the revenue process, because sometimes we look at inventory and say, oh, I need some more plastic here to be able to produce this particular item. I'm going to have to order from my vendors. So that's going to be included in the revenue process and a part of our diagrams. They're going to apply the graphics, they're going to deliver products to the customers, and then bill the customers and collect payment. Pretty easy, pretty straightforward. If I were to ask you, what do you think this company does? I would expect everybody in this room to be able to prepare a process summary very similar to this one. Maybe not exactly verbatim, maybe not exactly per step, but for the most part, I would expect everybody to know the high points, okay, to be able to pick out the relevant issues. Okay, with that, let's go ahead and talk about how we're going to use this to build our activity diagram. Now, remember, when I say activity diagram, that's our BPMN model, okay, BPMN diagrams. The good news is this is very easy. My expectations are very, very minor here. The thing is that we've got two different areas of diagrams that you will need to know. Unfortunately, my expectations for UML diagrams are substantially higher, but we'll talk about why that's the case in just a second. So here's our first diagram that we need to note, okay? And this is basically the only diagram that you need to be able to replicate for the exam. Now, I'm going to use two different terms. I'm going to say the term replicate, and I'm going to say the term interpret. When you hear replicate, that means that I would expect you to be able to prepare this diagram on the exam, and it's basically not going to change from this diagram. Whatever we're going to be doing for the exam is going to look very, very similar to this one, almost verbatim, word for word. We'll talk about what the differences will be. When you hear the word interpret, that's basically saying that you do not need to create this piece by piece on the exam, but if I put a picture of this on the exam, you should be able to tell me what's going on at certain points. For our BPMN models, this is our replication model, okay? This is what I expect you to be able to create on the exam. I'm hoping you're looking at this and you're silently cheering, saying, oh my gosh, I could do this in my sleep. Actually, if you can do it in your sleep, that's really impressive. But, obviously, you know what I'm talking about. I'm being facetious when I say that. This is going to be fairly straightforward, and it should not be too much more difficult. So let's talk about the important points that you need to know. First of all, you will notice here that we've got a pretty linear process that matches our model, our graphics description, our process description right here. For the diagram that you will need to know for the exam, there's a service step here which may not be relevant. Apply graphics. Remember, we talked about this as both a service and manufacturing firm. That service step is probably not going to be relevant to every particular scenario that you could have come to, because not every organization applies graphics to their things they manufacture. So this is unique to Sunset Graphics. So it's important to note here. What's really, really relevant are going to be our recognition points. So obviously we've got our BPMN diagram. We've got our starting process here, our starting event where the customer requests a quote. That's basically how we're going to recognize the beginning of this, is that a customer says, all right, I'm considering doing business with you. Can you send me a quote? We don't recognize a quote as an activity, but that's going to be a starting event. So then we provide the quote. That's going to be the activity itself. Okay. Then we go through the steps. So we walk through the process. Again, just remember, apply graphics. That's a step that's unique to this company. It's not going to be applicable to every single organization that we're going to look at. Then we have deliver order here. Now, this is going to be relevant to one of the things that we talked about before. Remember, we talked about the difference between cash-based accounting and accrual-based accounting earlier on, and I said accrual-based accounting creates some problems because that doesn't mean that we recognize revenue when we receive cash. It means we recognize revenue when the event occurs. So we deliver the order to the customer. That is our revenue recognition event, and it actually says record sale here. What does that mean? Let's go back a few slides. This is where we would record this transaction right here. We'd generate accounts receivable and we would record sales. All right. Now, why is this important? Because there's another corresponding event in the diagram that we need to make sure we're aware of, but it's not depicted in the diagram. What is that? That's this transaction right here. Remember that with every accounts receivable, we hopefully, fingers crossed, have an according cash payment associated with that. If we don't, we're doing our business wrong. So we want to make sure that for every accounts receivable generated, there is a subsequent cash payment. So look here, and we note here, for the delivery of order, we're going to record the sale. Now, what did we say a little bit earlier about freight on board? What was the default assumption? Freight on board shipping point. So once we actually put those goods on the truck and the truck leaves our docks, that is when we recognize that accounts receivable. That's when we record the sale. And the sales transaction is that journal entry, okay? That journal entry that I looked at before, okay? Now, by the way, before I was saying what journal entries would you have to record here? I said it's unlikely it will ask you to replicate journal entries. I may ask you to tell me what a journal entry would look like for a particular event. So even though I'm not going to ask you to replicate journal entries in this form, I may say, for the transaction where we recognize the sale, we record the sale, what is that? What is the debit and credit? You should be able to rattle off, we debit accounts receivable, we credit sales. That's not particularly difficult. I'm assuming everybody remembers that back from 220 and 221, okay? But why is that important? Because we need to understand what is the other part of the transaction. I apologize for the doom scrolling there or whatever that scrolling event was. I try not to scroll too much through slides, but this is really important to have a relationship here. So then we send the customer invoice and then we receive payment. The customer sends us the cash. This is our other recognition event right here, okay? So you'll notice that we have a little symbol right here that says, here's where the sales recorded. We should have another symbol right here where we record the cash receipt. Okay, we record the cash receipt. What does that look like? That looks like this event right over here, where the cash is debited and accounts receivable is credited. So even though I'm not going to ask you to record transactions, I do expect you to know debit to accounts receivable, credit to sales, how we record the initial transaction, and then debit to cash, credit to accounts receivable to record the receipt of cash for that transaction. That's pretty simple and straightforward, but it's really important to note how we would recognize that here. So you might want to make a little symbol here, a little bracket here if you're making notes here for receive payment, that this is the record the cash receipt. Now, real quick, when we get to the next chapter, I'm going to use the term cash disbursement. What's the difference between a cash receipt and a cash disbursement? I know that's a silly question, but that's come up before. When we say cash receipt, it means that we are the ones receiving cash, which is unique to the revenue processor in the area that would send us cash. The revenue process is not the exclusive area that we would receive cash in a business, but it's the only one we're going to study in this course, okay? What about a cash disbursement? That means that we are the one who are dispersing cash, who are sending cash out to another entity, which is going to be relevant when we're purchasing items, when we're purchasing inventory, okay, or purchasing any goods or services. That's when we would see cash disbursements. Now, again, I know that's simplistic, and some people are out there saying, Dr. Barnes, you need to explain that. Some of you may be silently thinking there, so thank you very much for explaining that, Dr. Barnes. I was confused, okay? If you're in that group, you're welcome. If you're not in that group, bear with me, okay? But I do want to make sure that the cash receipt, cash disbursement vernacular is the same. All right, just as I said, this is our basic diagram. This is what you need to know for the exam, all right? Minus any nuances. Like I said, applying graphics probably will not be relevant to the exam unless I specifically ask you about sunset graphics and say, what does a sunset graphics diagram look like, okay? So what are some iterations on this? Well, we can actually have customer interaction, which for the most part, I don't want you to worry too much about this diagram. I do think it's important to interpret, but this is fairly self-explanatory because we've already talked about where the customer is going to be asking for a quote. If we provide the quote, then the customer has to receive that. Customer knows once they receive a quote, they're going to place order for all or part of that particular quote. That's when we receive the order. And then when we deliver order, there has to be a subsequent receipt. They're going to be a subsequent receipt of the invoice, and they have to make payment. all of these are intuitive steps according to our diagram that we created for Sunset. So I don't think it's necessary to be able to create the replication diagram. That's just a memorization task at that point. But I do think to be able to interpret about which direction this is going would be a fair question. So if I, for example, if I say, all right, what would be the next step in the customer diagram, in the BPN diagram, after providing a quote? You should say that there's a corresponding message where they receive the quote. So there's a message flow here from the customer, from us, from our organization to the customer. Okay. So being able to interpret that's pretty basic and straightforward. It doesn't really get much more complex than that as far as the customer entity considerations. Another iteration on this diagram is going to be a BPN diagram with a decision gateway. So again, this is an interpretation diagram. I might put this diagram on the exam and say what's going on here at a given point here. There's not too much different from what's going on here, but we do have a gateway. And by the way, I'm very, very proud of the book because in earlier versions of this book, they had an open gateway and they didn't close their gateway, which really triggered my OCD because I really wanted to have a closed gateway. The new graphics in the book actually have a closed gateway because people like me complained. All right. So it's good to know that our voices can be heard out there. But let's talk about what's happening here with this gateway. So you'll notice here the check product availability or check product available because they didn't have room to put availability in there. So when we actually prepare something for a customer, we need our own raw materials to prepare those items. All right. We need our own raw materials. So we're going to check our own inventory and we're going to say, all right, we do have the inventory on hand to produce this item. Or we could say we do not have the inventory on hand. Let's order it from our vendor. That leads to an interesting condition. What if we go to purchasing and we go to the vendor and we say, all right, we don't have it on hand. Our vendor doesn't have it on hand. Can we still make that good for the customer? Answer is no. There's a decision point there. If that's the case there, that we can't make that good for the customer. This is basically where we're saying, look, we've tried to order the inventory we need for that item, not available. I mean, think about this, liken this to Taco Bell, okay, where you're going to be ordering your chalupa. I don't even know what goes on a chalupa. Is it tortilla wrapped in something else? Okay. I think I've had a chalupa before, but I'm not familiar with it. So we'll say the tortillas, okay? And Taco Bell says, okay, we're going to take your order. Say, all right, wait a minute. Do we still have chalupas back there? It says, no. It says, we can't order from the vendor because it would take too long. So they can't make your chalupa. So they're notifying the customer and saying this is not available to you. So that's a possibility, certainly a possibility. They could be out of the good that you want to buy and they can't replicate that good. Us as the producers, the same thing could happen is we're producing, but we do not have the merchandise we need for that point in time. Now let's assume that we do actually make the purchase of the goods that we need to manufacture. Purchasing will take place down here. The decision gateway will close and then we go back with the rest of our process. So not so much change in the process, except we can add a gateway where we have to actually determine, are we able to make the good or not? If the answer is yes, we go on with the manufacturing process. The answer is no, process ends right there. That's an interesting point, by the way, because if you actually interpret this diagram in the exam, you'll notice that there are two possible ending points. One is the normal process that we walk through where we actually produce it to the customer. They pay us, everything is fine. The other one is where we say, I'm sorry, but we can't do business with you. We do not have goods available. So there are two possible endings there. One of those is a sad ending. The other one is a much happier ending. So I don't know. Take what you will from that. All right. Oops, I got a little bit ahead of myself. So now we're going to move on to UML diagrams. Okay, we're going to move on to UML diagrams. Now, let me just say right now, this is a preface to this. For the UML diagrams on the exam, this has historically been the area that my students have struggled. I'm going to tell you right now, take this seriously. Do not try to wing this. Make sure you learn this as well as possible, okay? I'm going to be asking for a lot from you on this because I think it's important. This is unfortunately not easy to simplify because remember, as I said, whenever we create a class in the UML diagram, we have an additional, increases the number of associations possible. Let me explain what I mean by articulating that, okay? If I have two classes in a UML diagram, how many possible associations are there? There is one possible association. It's a line between those two classes, okay? If I have three classes in a UML diagram, how many possible associations there are there? There are three, because I can have three. So imagine three rectangles, one on top and then two on the bottom, like in a triangle. You can create a line between each of those three possible associations. If I have four classes in a UML diagram, how many possible associations are there? See, how many people are good at iterations? 6, okay? How about if there's 5 classes in a UML diagram? How many possible iterations are there? There's 10, okay? This increases at an exponential scale, all right? So every single time, now keep in mind, not every single class will be associated with every single other class, but I'm kind of making you aware that the reason that these become more complex is because every time you add a new class on there, you open up a much greater number of associations than you had before. So this is why it's so challenging and so difficult, and why we're going to try to keep these associations down to a small number. Now, for our default diagram, I believe we are going to have 7 classes, okay? Not all of them are going to have associations with one another, but there's still going to be a bunch of them. So let's talk about it. Let's talk about how we're setting up our UML diagram first. So first of all, we need our classes. Specifically for our diagrams, we're going to focus on our entities. What are our 3 entities again? What are those categories called? Resources, events, and agents. Okay, resource, events, and agents. There were classes of the diagrams. Okay, so let's go ahead and start out with the quote process. We're gonna build this UML diagram. We're gonna build it up in parts. Okay, the quote process. Our event is our quote. Okay, that's going to be our triggering event for that particular item. Who's involved in a quote? Can we say that probably somebody at the organization, an employee at the organization? That's an agent. And the customer is probably going to be involved in the quote. It's weird if we have a quote with no customer. So where'd you get this quote? I made it up. Yeah, that's fraud. All right. So yeah, you got 2 entities there. And then what is it they're going to be doing? They're going to be taking a quote for products. They want to know how much it's going to be cost to buy those particular products. So pretty straightforward UML diagram. So this is our first event. This is basically a triggering event, the beginning of that BPMN diagram, that event that actually spawns the process. This is how we represent this in UML diagram. Unfortunately, we can't stop here. As much as this is a good representation, we have to move on. Now, I do want you to make a note before we move on to the next diagram. We are not going to increase the number of agents beyond 2. So these are our 2 agents, all right? These are our 2 agents. Also, good news is that for the most part, when we actually look at other processes, we're going to see a replication of these 2 agents. The terminology is going to change, but we're still going to see a replication of these 2 agents. We'll see what that means next week. All right. But we do have to increase the number of resources and, most importantly, the number of events, because we have multiple events. So going back to our BPMN diagram, here's where our first event occurs. Where are we actually going to be having our next event? That's going to be an ordering process where we deliver that order. So let's go ahead and recognize our next event. Okay. The good news is we're only adding 1 class to this diagram. The bad news is we're adding multiple associations. Now you will notice that in these diagrams, we had 3 associations here. It was pretty straightforward. 3 associations, and we also had the multiplicities there. Okay, so you had to have your interpretation. By the way, I do want to make a note on these multiplicities. Will you be responsible for the multiplicities on the diagrams? Yes, you will. You also be responsible for interpretation of those multiplicities and other questions. Are these multiplicities subject to interpretation? To a degree, yes, okay? You can actually put multiplicities up there that are not identical to the ones up here, but you have to be able to explain what those multiplicities are. If your explanation is not consistent, like you say, okay, I'm going to say it's a 0 to 0 multiplicity and then provide some reason. We've not talked about any 0 to 0 multiplicities in this class, so that would not work. You have to have a distinct explanation that's sensible and intuitively sensible. So moving on here, we've got our associations. We add orders, okay? For every quote, there's going to be an order, or for every order, there's going to be a quote, I should say, okay? Quotes involve the customers and involve employees in the process. So we added 4 associations to this diagram just by adding 1 class. The nightmare scenario right there. But we're not done, because we said there are 3 possible events, okay? What was our third triggering event? Well, if we have an order, the order in a business-to-business environment suggests that there's going to be credit extended, okay? That credit is extended. What do we need to have a subsequent event that triggers to eliminate the credit? Cash receipt, yes. Cash receipt is going to involve not only the cash receipt itself, but a new resource, because we don't just send products out for fun. It would be nice if that was the world we lived in, where we could just send customers out stuff for free. I'd be ordering cheeseburgers online every single day, but that's not the world we live in. We actually have an exchange of merchandise. They send us products, we send them good thoughts and feelings. Right, that's exactly what I was asking. Cash, we're sending cash, okay? So our final diagram is going to be receipt of cash and cash receipts event, and the cash is going to be recognized over here. Now, the good news is we've not added too many more associations. Again, we added 2 more associations here, which means that we could have probably added 14 possible associations within the diagram as a whole, because there's seven items now. But cash only has one association. That's with cash receipts, which is very easy. Cash receipts associated with orders, with customers and employees, because employees have to facilitate the receipt of cash and customers have to pay the cash, and a cash receipt has to be associated with an order. By the way, I strongly recommend, we didn't go through them point by point because at this point, first of all, we got 10 minutes left in class and I still want to talk about controls. But we didn't go through these multiplicities point by point, but I strongly recommend that you review the multiplicities. They are self-explanatory, but if you're not familiar with how the multiplicities work, they can get confusing very quickly. Just as a reminder, when we talked about multiplicities in UML diagrams, if I'm talking about this multiplicity right here at number 1, this one-to-one multiplicity, where do I start? Start with quotes, okay? A quote can be performed by one employee and only one employee. That's what this one-to-one here. So remember, when we're looking at a multiplicity, we start with the far class and move over to the near class, okay? Employees can be involved in 0 quotes or involved in many quotes. That's what this 0 to many right here it is. I'm not going to go through these point by point because, like I said, it would get very boring and very tedious, and we're going to do a lot of that for homework anyway. But I do expect you to be knowledgeable about these multiplicities and understand how they're interpreted. All right. Remember I talked about the replication task for the BPMN diagram, and I said that you're going to have to replicate a UML diagram as well. This is it right here, okay? This is it right here. What you see in the slide, this is my expectation. There are 2 more that are just as detailed. They're going to be for the other chapters. And again, I apologize. I know that's rough. This is a lot. The good news is that it could be worse. I don't know. That's probably not a good justification. So I could make it a lot worse if I wanted to. No, that's not a great justification, but I do think this is important to recognize at least the remedial level. The associations, the multiplicities, the classes, all of these are really, really important, okay? So you will be responsible for replication on this. Like I have said, I have asked questions on this in the past. People have struggled on this in the past. Do not blow this off. It will be a significant portion of the exam, okay? And if you do not take this seriously, you will miss these points and you will be very unhappy with your grade, okay? So this is just forewarning. There will be 3 diagrams or 2 diagrams that are just like this one for 3 in total. Yeah, I would expect you to know all 3 to this level of detail. Now, can it get worse? The answer is yes. We could add conceptual structures to the diagram. For the most part, this is an interpretation diagram, okay? I will not ask you to place conceptual structures on your UML diagrams for the exam, but I may ask you what are some possible conceptual structures that we can include in the diagram, and you would need to be able to understand the categories. So don't worry too much about them. These are going to be interpretation items here. So interpretation, again, low-hanging fruit might be is to say, okay, consider the possibility of adding conceptual structures to this diagram. What might be some possible conceptual structures that are included? What is a conceptual structure again, anyway? It's been a couple of weeks since we talked about it. Remember, it's anything that is not an entity, so it's not a resource, event, or agent, but managers may want information on them. So you can kind of tell here, we got 2 conceptual structures that are included here. These are not resources, by the way, even though they're in the resource column. These are not resources. These are just additional items on which the managers want information. So they want to be able to categorize products according to certain areas, okay? So like saying, all right, these are graphics, these are decals, these are banners, stuff like that. Different categories that can be managed, and they're managed by employees, which is why we have 2 associations here. Order status is basically what is the condition about it? Has it started production? If it's wrapped up production, is it in storage? Has it been delivered to the customer? All these represent source information. What is the potential for conceptual structures? Is it just beyond these 2? Are these the only 2 possible conceptual structures in this diagram? No, the answer is it's probably literally infinite, okay? Literally infinite. Maybe not literally infinite because that would imply more words than exist in the English language. But effectively, there's not a limit on the number of conceptual structures we can include here. Anything that includes information that we want to know, we can look at that here. So there's a possibility that you could include conceptual structures that are not listed here. Those are all possibilities that we can consider. All right. So UML diagrams, not fun, but really, really important. Please make sure that you take those seriously as we're preparing for the homework on Wednesday and as you're preparing for the exam. Let's wrap up. Let's talk about business rules. And specifically, we're going to talk about internal controls. So we talked about business rules a little bit last week and the week before. And remember we talked about business rules. I said that there were 3 categories of business rules. There's obligatory, prohibited, and allowed. Those are the kind of categories. But why do we have business rules in the first place? And so this slide is saying they're trying to make sure that information systems operate in a consistent and effective manner. But probably more importantly, we think about business rules is that this allows us to create controls for how the organization operates. Now, we've talked about controls at a basic level. Remember my definition for control. It's a response to a risk. Business rules basically classify or categorize the risk. Controls are how we deal with the risks, okay, or how we deal with the risks. So some examples of what we can think about controls. We've not really talked about specifically what controls are, but there's some ways that we can think about controls. And you probably have heard of some of these before. So approvals, authorizations, verifications, reconciliations. Has anybody done reconciliations like a bank reconciliation before? Okay. So hopefully you do that in your everyday life. Hopefully you know exactly what your bank balance is and you're not going over, because spending more than you have in your bank account's a bad idea. All right. But you're doing your bank reconciliation, and the whole goal of that is to make sure that a transaction that you conducted was a legitimate transaction. How many people review their credit card bill on a regular basis? That's probably, I go to say everybody should, but then again, somebody would say, well, I don't have a credit card, Dr. Barnes. And if I say, good for you for going off the grid, okay? But if you don't, I'm assuming most people have electronic transactions, and you should review those transactions, because you're going to be looking down and says, okay, Truman State, trip to Tahiti. Oh, I did not take a trip to Tahiti. I'm pretty sure I remember that, okay? You need to keep an eye out for transactions that are not legitimate, okay? That's why we have those reconciliations, so making sure that's the case. Also, reviews of operating performance. Does anybody have a part-time job where they had to sit down with a manager and they gave you a review and they said either really, really nice things or really, really not nice things? Do you think they do that just because they want to make you pump you up and make you feel good about yourself? No, it's a control. It's basically trying to identify areas of strength and areas of weakness and trying to remediate wherever it's possible. So if you're doing a good job in a certain area, they say, keep on doing good work. That's not just a pump of your ego, because they legitimately want you to continue operating strongly in that area, doing a good job. If you're not doing a good job, they're not trying to beat you down. They're trying to say, look, this is an area that's really important to the organization. If you don't conduct yourself well in that area, then you're not going to be able to, we're not going to be able to continue keep you in that position. In the worst scenario, if you get into a position where you're not doing your job properly, they may say, we have to let you go and replace you with somebody who can do that job. Hopefully that's never happened to you, will not happen to you, but it does happen in the real world. Then we have security assets and segregation of duties. And you'll notice a picture of a car over here, okay? This is not just to show you that I know what a car looks like and I can spell the word, okay? This is an acronym, or an acronym that for one of the most important things. So remember, I said internal controls are one of my favorite things to talk about. This is my favorite form of internal control. It's called segregation of duties. Segregation of duties. So what is segregation of duties? That's basically these three letters here. CAR, custody, authorization, and recording. More specifically, three responsibility areas that should always be associated or separated in a process area: custody of assets, authorization of transactions, and recording of transactions. Now consider the possibility, okay? Consider the possibility you work in a warehouse around inventory. You have strong custody of that inventory. You can move that inventory for shipping. You can move it for storage, whatever. You have your hands on that inventory all the time. You do not have the ability to record inventory transactions or to authorize inventory transactions. Why? Because you might be tempted, if you could record inventory transactions, to say, I'm going to record an inventory transaction that goes to my address. All right, I'm going to put it in somebody else's name and some under a vendor, but it's going to be delivered to my goods, and yeah, free inventory to my house. That'd be great. Okay, that'd be great. But unfortunately, from a business perspective, that's fraud. Okay, so we want to make sure we try to avoid that wherever possible. Also, we talk about business or information system controls. We talked about two categories of controls. We're not going to get through all this. I'll probably wrap up a little bit on Wednesday, but we'll see what happens. So general and access controls, these are basically information technology controls that limit who can access the system. How many people logged into the computer when they walked into class today? That's an access control. You had to enter your username and your password. That actually limited that. Also, we've got application controls. This is an automated audit trail process. So whenever you go anywhere on a Truman State system, guess what? They are tracking your activity, sometimes directly, sometimes indirectly. Directly through Brightspace. I can tell when you actually access Brightspace. There's a log that shows when each of you in this class have accessed Brightspace. And I'm proud to say everybody accessed it as of last Friday. So good job. I knew you did because you had to submit assignments, but yeah, so everybody's doing a good job in that regard. So how do we perform tasks? How do we access our tasks is going to be relevant. That's all I'm going to talk about for today. We'll wrap up the rest of this on Wednesday. Remember, homework on Wednesday as well as NetSuite. Have a good day. See the email sent.